The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Good evening, all. This is Omkar from Hdfc Securities marketing team. So today we are here with us our new topic, Hdfc Nifty PSU Bank ETF. So basically, this is a new ETFs from Hdfc AMC, which they are going to launch recently. So to explain more about this fund or explain about this ETF, we have Mr. Uh, Shikhar Sethi here. So Shikhar, over to you.
Okay, thank you, Omkar. Can you please load the presentation? Thanks, Omkar. We can move to the next slide. Good morning, good evening, everyone. So today we are going to be talking about the Nifty HDFC Nifty PSU Bank ETF. So before we get into the specifics of the ETF, we'll talk about PSU banks in general and what is the investment case as of today. Why are they? Where is the opportunity? So as you all know, banks, at a very general level, are very important for the economy because they give loans which you can use to purchase homes, automobiles, do capex, if your company, so on and so forth. So they are a very important part of the economy. And within banks, PSU banks have been one of the sort of mainstays of the banking sector. Now, what we are going to show in the next few slides is that while the decade of 2010 to 20 was quite difficult for PSU banks, where they sort of had a lot of losses and a lot of NPA problems, they have taken several proactive steps to address those issues, and they have made several sustainable improvements in their fundamentals through this whole cleanup process. So we'll see that in the subsequent charts. But here, the point we want to make is that they have made sustainable improvements relative to the previous cycle, and that is helping them achieve, decade high returns on assets. Their capital adequacy is high. NPAs are at the lowest in a decade. So all that positive action that they have taken is bearing fruit, right? So the what we also want to highlight is that while the fundamentals have improved, the valuations are still not at very demanding levels. So we'll see the chart about this, but the price to book ratio of these banks is still close to the long term average. So fundamentals are at decade highs, but valuations are still close to the long term average. So this suggests that it's possible all the good news is not being reflected in the valuations just yet, and that's why the opportunity is created for investors. So we'll go into all these points in more detail in the next few slides. Next slide, please. Okay, so this is the first slide we'll talk about when we are, discussing bank fundamentals. So this is showing you the capital adequacy ratio of PSU banks. You will see. So in a nutshell, what is capital adequacy? It's the amount of equity that the banks hold, which gives them the ability to withstand losses if they face a bad loan problem, so on and so forth. So the more capital a bank has, the better it is, because it means that they are more resilient to any future economic shocks. Now, if we see here, for PSU banks, they had their lowest capital ratios in around 2014 and 15. Since then, very steadily, it has been improving, and even especially after COVID, we've gone from about 12.9 to 15.5. So this is much higher than the regulatory minimum of 8%. And the fact that the capital adequacy is at a decade high level is generally, positive for these banks, because like I said, it means that they are more resilient to any future downturns. Um, so just one second. Okay, so that was it on the capital adequacy ratio. After that, can we please go to the next slide? Omkar, next slide, please. Okay. So capital is one part. Second part is what are, what has been happening to the NPA side. So here we can see again the gross non-performing assets. Uh, they peaked in 2018. So after that, the banks have been taking proactive steps, and they've been reducing, they've been cleaning up their balance sheet. And we can see the gross NPA ratio has gone from, come down from almost 15% in 2018 down to around 4 or 5% now. Uh, Even the chart below, which is discussing slippages. So slippages is how many new bad loans the PSU banks are encountering in a year. That is also at decade low levels. So the lower your NPAs, the lower the slippages. It's a sign that the bad loan problem that these banks had, it has been addressed, and at the moment they are not facing fresh increases of bad loans. In fact, the new increases of bad loans are happening at a falling rate. So it's indicative of better profitability and good balance sheet quality in the current economic cycle. Next slide, please. So, the flip side to that is that even the provision coverage ratio, so this is how much banks have to set aside for potential future losses. That is also, you can see, at a very high level. In fact, this is the highest level since 2004, so almost 20-year high. And this is important because it means that even suppose the economy was to weaken and bad loans were to start going up again, already the PSU banks have set aside a fair amount of provisions to protect themselves from bad loan increases in the future. So the fact the ratio is high means that they have to increase provisions lower and by a lower amount going forward. Obviously, it depends on how bad the stress is, but by and large, with such a strong provision coverage ratio means that they have already taken preventive action against future economic deterioration. So that's a positive for today. And last slide, on these fundamental metrics is the return on assets. So you can think of return on assets as an efficiency measure for the for a bank. And the higher the number, the better, because what it's saying is that for a given amount of assets, these banks are able to generate superior return. So here also you can see that in 2018 the return was in fact negative because these banks had big NPA problem. They had to take huge losses, huge write downs. But since then, after all these fundamental improvements have started taking hold, and now you can see the return on assets is again, it's close to the 10-year high. So going back to almost 2012-13. So very clearly, the graph is changing its shape from 2018 onwards, and that is in a one chart, sort of showing you the improvements that these banks have undertaken and also the results. So that's clear in this chart on return on assets. Next slide, please. Okay, so we saw in the previous several charts that we've had a lot of fundamental improvements vis-a-vis capital, vis-a-vis provision coverage, falling bad loans, and rising return on assets. So let's talk about some other changes. When we say that the banks have made sustainable improvements, what else have they done to sort of protect themselves against future weakness? So one thing is that they have changed their lending pattern. So in the past, they used to lend quite a bit to corporates. You can see one of the leading PSU banks had almost 38% of their loans, to corporates. But Now, as of second quarter of this financial year, it was down to around 29%. So what these banks have done is that, in the past, the corporates had some of the balance sheets had deteriorated, and that led to bad loans for the PSU banks. So now these banks have taken a more diversified approach to lending. They are now doing less to corporates as a share of total, and instead are doing more to retail and housing specifically. So with housing, the bank has the advantage that the loan is secured by the house. So if the borrower is unable to pay, at least the bank still has the house as an asset, right? So generally, it's perceived to be a little safer way of lending. So this is again a positive. Both we've just given a few examples due to limited space, but both banks you can see are diversifying their loan book. They are putting more towards housing and retail and less in the corporate space. Next slide, please. Okay, so final slide on fundamentals. Just again, this slide is basically saying that PSU banks, I mean, everyone is familiar with them. Most people will even have an account with them. So as a result, they have a very strong, what is known as Kasa, so current account, savings account franchise, which means that they are able to get deposits which are generally quite cheap for them. They don't have to pay much on the deposits as opposed to alternative forms like if they had issued debt or borrowed other kind of money from the capital markets. So the fact that a lot of their deposits are current account, savings account, which are generally low cost, it's beneficial for them because this lets them, even though interest rates have gone up, we've seen from 2020, the RBI repo rate has gone up by 200, 250 basis points, but the cost of funding for these banks has gone up very slowly. Why? Because they have low cost savings and current account deposits. They have been relatively immune to rising rates, and even if rates were to stay high at these levels for a while, these banks are still better protected than others like NBFCs or so on, who have to borrow more from the market. So the positive here is that because of their strong brand recall, because of their several years of history, because of the government backing, they have a lot of low cost current and savings account deposits, and this also definitely is a support in times of stress and aids in their overall profitability. So with that, we can move to the next slide, please. Next slide, please. Okay, here, one thing also that's important to mention is that in the past, there sometimes was a, no, sorry, can you go back to the digital slide, please, Omkar? So here, no, the one before this. Yes, yes. So here, there's a perception that in the past that PSU banks were they had not invested much in their digital infrastructure. So, Omkar, the slide 8. Yeah, so there was a perception that they had not invested much in their digital infrastructure, and generally their digital offerings were of poorer quality to private banks. This was the general perception. But you can see these are just a snapshot of some examples, but they have been investing heavily on the digital side as well. And now they also have very sort of state-of-the-art apps, so on and so forth. And they are now that gap that used to exist between public and private, it has very much reduced. So, from the slide, we can see that one of the like large PSU banks, they made almost 24,000 crores of loans, just through the pure digital route in FY23. They are opening a huge amount of 23,000 accounts per day purely through the digital route. So these are just to give you an example that these banks have definitely invested in the digital side, and they are much more competitive on this front, which is also a strong positive for them going forward. Next slide, please. Okay, so now we've talked about the fundamentals. Let's for a minute now look at the valuations. So this chart over here is showing us the forward price to book ratio of the PSU banks over a long period of time. And we can see that the current value, right, it's around 1.3. It's very close to its long-term average. So we've seen that many fundamental metrics like your capital adequacy, return on assets are at highs, your NPA slippages, they are at decade lows. But if you see, valuations are still close to the long-term average. So it's possible that these valuations are not fully reflecting the improvement in the fundamentals over the last several years, right? So this is potentially what is creating the opportunity that since the bank's fundamentals have improved but valuations are still close to the long term average, investors can look at taking, sort of advantage of this opportunity by investing in the PSU bank ETF. So this is what we wanted to highlight, the gap, current potential gap between valuations and fundamentals. Next slide, please. Okay, so now we've gone through, the basics of the banks, the sector as a whole, the valuation, so on and so forth. Let's have a quick look at what the actual index, if you buy the ETF, what is the index that that ETF is tracking? You can see that here in this slide. So there are about 12 constituents. Largest is SBI and Bank of Baroda, then followed by Canara Bank, Punjab National, Union Bank of India. And on the right side, you can see, the price earnings ratio, price to book ratio. These are generally on the lower side. As we saw, it's sort of consistent with the chart on the previous slide. But this just gives you an idea of when you buy the ETF, these are the stocks and these are the weights that you will get exposure to. Next slide, please. Okay, so one thing I think is important that we discuss here is that what are the advantages of ETFs to get sector exposure? Why not just buy a few individual stocks yourself? So the reason is that there are two main reasons. One is that there's less impact of a company-specific risk. So say, for example, you have 12 stocks, or let's say you just buy 3 or 4 stocks, right? And we've seen this happen in the past. Sometimes some bad news comes about, one of the bank's app or one of them may get hacked due to, some cyber security issue or something. Then what happens is that that one bank will face a sort of big hit to its price most likely. So if you have a concentrated portfolio of 3 to 4 names only, that can potentially hurt your portfolio returns. But when you spread, as the ETF does, when the investment is spread out over 12 names, or so definitely much more than 3 to 4, it reduces the impact that even if bad news were to occur to one company, it reduces that kind of impact on the overall portfolio. So as an investor, if bad news does affect a company, it's still little bit, it will not have as big an impact on the portfolio, and that makes it easier for you to hold this kind of ETF through volatile periods. So that's the first advantage. Second advantage is that, if we just look at the pure volatility, the index, just the index overall, it's actually less volatile than any of its underlying components. So same thing, if you had just said, yeah, I'll just buy 3 or 4 stocks of the PSU bank, then, it's possible that, again, you can see here, they have fairly high volatility. So because they are moving around quite a bit, it can become unnerving for investors if they feel it's in excess of their risk appetite. But with the PSU bank index, when you buy the ETF, the index it's tracking, it has lower volatility than all the any of the individual components. So that means that again, it may be a little easier for the investor to handle that volatility because again the investment is diversified across 12 stocks and it's not a concentrated portfolio. So those are the two, main advantages, that you have less exposure to any company specific risk. Second is that on aggregate, the index is volatile than, just buying 3 or 4 stocks on their own. And lastly, it's quite sort of common, but it's just the convenience factor that instead of you having to buy 3 4 securities, check the weightages, do all of that, the you can just buy the ETF. So you buy one instrument and automatically you are getting exposure to 12 PSU banking stocks. There's no need for you to do individual stock selection. So once you make up your mind ki hanji, I like PSU banks, I think the sector has room to go up more, then the ETF is a very convenient way for you to get exposure to the sector. Next slide, please. Okay, so we'll quickly go through the returns here. So this is basically, showing you how the PSU bank has done over various horizons. And you can see that in the last 1 year, 3 year, it's definitely done well. It's done considerably better than Nifty Bank or Nifty 50, so on and so forth. But over a very long horizon, it's not done as well. The reason for this, Omkar, can you go to the next slide? Reason for this you'll see here, it's more visible here in this table, that as I mentioned, the decade from 2010 to 2019-20, that was a very tough period for PSU banks because they had high NPAs, a lot of losses, so on and so forth. So if you see here on the left side, FY12 to FY16, consistently it was the worst performing index overall. That's why over long horizons, the returns of this index do not match up to bank or 500 or 50. But in the last 3 years, we've seen a complete trend reversal. So from FY22 onwards, right, for those 2 years, 22, 23, and so far as of December end FY24, we've had the PSU banks actually do much better than both Nifty Bank and Nifty 500 and 50. So again, it's up to the investors, if they believe the sector has more to run and it has room to reverse, its massive underperformance in the previous decade, then they could consider, allocating some amount of their investments to this ETF. Next slide, please. Okay, so now we are getting close to the end of the presentation, then we can take questions. Next slide. So here just a summary of why one can look at investing in this Nifty HDFC Nifty PSU Bank ETF. We've talked extensively that the fundamentals have seen a sustainable improvement. A lot of metrics are at decade high levels. Banks have changed their the PSU banks have changed their lending patterns, trying to make it more diversified. They have a good Kasa franchise. They've also invested, a fair amount in their digital capabilities. So a lot of, changes on the ground, and you are seeing the results of those right now. So improved fundamentals. Valuations, on the other hand, are still close to the long-term average. So it's put possible that they are not fully reflecting all the improvement in fundamentals and this gap. So very good fundamentals at the moment versus valuations close to long-term average is where the opportunity could lie for investors. And two other reasons are that, as I mentioned, that if you buy the ETF, it frees the investor from choosing individual stocks because the ETF will automatically give you exposure to 12 different stocks. And it's a convenient way of holding your investment, tracking its value, so on and so forth. And lastly, why HDFC AMC? So we've actually been, we were one of the pioneers in passive. We are in Sensex and Nifty index funds have been around for over 20 years. Our ETFs as well have been around from 2010 onwards, so almost 13 years. So we have a lot of experience and extensive knowledge of the space. So that's one of our good reasons to invest with HDFC, because we've also sort of have the very strong risk management and investment processes to keep the tracking error, tracking difference of these products on the low side. So that's a summary of final summary of why you could consider investing in this ETF. Next slide, please. So here we've just mentioned, who this product could be suitable for. So it's essentially, if someone believes that the PSU banking sector is a good place to invest, as we've described, then you can get diversified exposure. But here it is important to note that it is, the investor should also have a high risk appetite, because these banks are generally, we've seen, even though the index is less volatile than the individual stocks, it's still, more volatile than, let's say, Nifty 50 or other commonly followed indices. So the investor should allocate also an amount with which they are comfortable, because this product is generally going to be more volatile than more diversified equity products. So here you have exposure only to one sector. So if the sector does well, this will also do very well. But if, for example, there was to be some kind of economic downturn or any other risks materialize, then investors also have to be prepared to accept higher downside volatility. So when deciding your allocation, please keep in mind that the riskiness by measured by volatility for this product is higher than other equity products. Next slide, please. Okay, this is just a very small summary of the sort of fund facts. Important things to note are that the minimum amount for investment is rupees 500. After that, once the ETF is listed, which would probably be around um, the first week of February, approximately. Once it's listed, then investors can buy more by just purchasing units on the market. And if they want, many brokers are allowing SIP into stocks and therefore also ETFs. So you, as an investor, you say that, okay, look, I have some money, I want to invest in the NFO, but I also want to do an SIP. That is very much possible. Just wait for the ETF to list, and once it's listed, you can set up the SIP even for the ETF, just like your other SIPs you may have set up for other stocks, so on and so forth. And like I said, most brokers are allowing this feature. So please keep in mind that you can very much do SIPs using ETFs. Next slide. This slide just is telling you that all the investment is going to be in the equities, which are part of the Nifty PSU Bank Index, so 95 to 100%. In practice, the vast majority, so very close to 100%, is allocated, and only a small amount of cash is kept in the ETF to meet expenses, so on and so forth. So this is just a very basic asset allocation table. Next slide. And your standard riskometers, so telling you, as I was mentioning earlier, that this has a as per SEBI's classifications, the index has a very high risk because it has because the underlying equities themselves are fairly volatile. Next slide. Next slide. We can just go to the disclaimer. Thank you and disclaimer. So that's it from my side. Can you, Omkar, can you just go back maybe to the slide on the snapshot of PSU Bank Index? So that is slide number uh, 10, please. So before concluding, I just want to add one more thing, because many investors have this question: what is the difference between this index and the Nifty Bank and Nifty Private Bank? So Nifty Bank and Nifty Private Bank, they both have a very high weightage to HDFC Bank and ICICI Bank. So in both those indices, HDFC Bank and ICICI Bank together are almost 50% of those two indices. Whereas because they are not PSU banks, by definition, they are not in this index, right? The only large PSU bank which is also in the Nifty Bank Index is State Bank of India. So here it has 32% weight, and in the other, in the Nifty Bank Index, it has around 10% weight. So to summarize, Nifty Bank, may you are getting primary, your two largest holdings are HDFC Bank and ICICI Bank, which are almost 50%, whereas in the PSU Bank index, the two largest holdings are State Bank of India and Bank of Baroda, and that is also around 50% of the total weight. So this is, because it comes up quite often. What is the difference? This is the main difference, that one is sort of, this index is heavy on SBI and BOB. The others are heavier on HDFC Bank and ICICI Bank. So just wanted to give that little explanation. And with that, we can move on to questions, please.
So, dear customers, we are open up for the question and answer. So, if you have any questions, you can ask in the chat box as well as question box. So, Mr. Shikhar will answer. So, Shikhar, we have one question from Mr.
Yes,
Abhishek Singh. So, he is
yes.
asking what is the return expectation from for 3 to 4 years for this from this fund.
Okay, so can you go back to slide 13? So, sir, we'll not be able to give any, sort of forecast in that sense. But what we can at least tell you, through statistics, is that over the last 1 year, for example, this index has had a beta of around 1.4 to the Nifty. So that means that if Nifty has gone up by 10%, then this has gone up by, very roughly around 40% more. That's a statistical sort of measure. It's not exact, but that's how we get the number from beta. So if you are generally, if the investors' view is that they are generally comfortable with the equity market, they think the next few years will be strong for the Nifty, then PSU Bank could go up more than that. But it would be difficult to give a precise return expectation. And one more thing to mention is that, I've said it before, but this index, because it sort of has a potentially higher return than Nifty 50 or Nifty 500, that comes also with higher risk. So one should please keep that in mind while deciding the amount you wish to allocate.
Mr. Bala Murugan NR is asking when we can start investing in this fund.
So the NFO is already open. At the moment, the dates are from, so it opened on the 12th and it's open till 23rd. So you can sort of, log in through your broker, go to the NFO section and invest through that way. That's how to invest in the NFO. After that, once this ETF is listed on the exchange in probably the first week of Feb, approximately, then you can buy more units as and when you want on the exchange itself. So right now, NFO is open till 23rd, which is Tuesday. And just to mention, you can, like I said, either through your broker or, because they will have a link to our website and the CAMS link. If by any chance you are unable to access through them, then you can also come to our website, hdfcfund.com. There's a banner on the first page, which is, basically providing you a link to the Invest Now section. So you can just click on that and it will take you to the same page where you can enter your details, make the payment, and then the application will be complete.
Mr. S. Tripathi is asking, CASA ratio is fine, but more exposure to retail and agriculture will affect the bank income. So, any thought on that one?
Can you just sort of clarify that more?
So the
And you can
question
also
is,
go, yeah, you can also go to, I think it's slide 6. Yeah. So I think one way to look at it is that, your agriculture loans, for example, have stayed more or less flat. Like, so if you see, if you look at it from 2013 or so, then you're actually at 8% versus 10% then. So your agri loans as a share of your total loans have come down. That we can see for the first bank. Even for the second bank, that share is almost constant at around 12 13. So from that perspective, these where we see the biggest change is that the share of corporate has reduced, and others like housing and retail have improved. And one more thing worth mentioning, have gone up. One more thing mentioning with retail is that when we are talking about consumer loans, the bulk of the the loans have been on are housing linked. So therefore, like I said, that the bank has the house as an asset if the borrower were to default. On the other hand, the other parts of the lending, which is smaller, basically maybe unsecured and riskier. A, the interest rates are higher on those, and B, those are generally small tickets. So unlike a corporate where even one or two big loans could really sort of affect the NPA ratio, here, because on the retail side, because the average ticket size is quite small, even if there are a few sort of cases where people are unable to pay back their loans, it doesn't have quite the same impact as one or two large corporates defaulting. So that was the kind of point one was trying to make from these two slides, that the loan book has become more diversified, and generally the segments in which the lending has gone up is less sort of systemically risky than pure corporate exposure, as used to be the case.
so again, Mr. Abhishek is asking,
Yes.
what are the merits and demerits of investing in ETF versus index fund?
Okay. So, sir, it's very much a question of your sort of personal preference. Why I say that is that if you have a demat account, then you could invest either in ETF or index fund. There's no issue. Index funds are actually mostly for people who don't have a demat account. So if they want exposure, then they tend to go through index funds because, like I said, no demat account is required. On the other hand, if you're an active investor, you have a large stock or ETF portfolio, then ETFs give you the advantage that you can, they'll be in your demat account, you can see them, track their value easily with the rest of your other holdings. Whereas if you had an index fund, then you'd have to combine the two, and that could get more sort of difficult. So if you have a demat account, then ETFs are, investors prefer ETFs because they are able to view their holdings along with the rest of the stock holdings. Another difference is that in ETFs, so like I said, SIPs are allowed, but for other kind of transactions like STPs or SWPs, those are only sort of possible through index funds. So, that's what it really depends on what you are looking to achieve. If you are just wanting to sort of buy and hold and not do anything like an STP, SWP, then ETF is also a good route, as it will be held in your demat account. And just mentioning that here at this point, we only are offering the ETF on this sector. So in case you don't have a demat account, you will not be able to participate in this ETF.
There's one question from Mr. Saurabh Kothari. So he is saying can you brief about NFO in short, how it is different from equity and derivatives, it is going to be listed on stock exchange or in the market?
Right, right. So, sir, you can think, and sorry, just one more point to the previous question of Mr. Abhishek. So, when you were asking what are the difference between ETF and index fund, one other difference is that on average, not for this specific scheme or so, but on average, ETFs tend to be their total expense ratio tends to be lower than in index funds. Just on as a general rule. Of course, you can some cases that may not be true, but in general, ETFs have a lower expense ratio than index funds. So that was just wanted to add on for Mr. Abhishek. Now on this question, what is an NFO? So sir, you can think of it. You can think of an NFO. So what IPO is to stock, NFO is to mutual fund, or NFO is to, yeah, in this case ETF. So in an IPO, you give the company money, and then after once the listing process is done, then the shares are so if your application, when you make the application, your money is deducted and you will get shares in return. And once the share is listed, then you can buy or sell it as you please on the exchange. So with an ETF, it's very similar to an IPO. Here, the again during the subscription, so the NFO period from 12th to 23rd, you will decide how many units you want, make the payment, and after the NFO closes, the units will be allotted to you, and the fund manager with all the money that has been collected will go and buy the stocks of the index. Once all this is done in early Feb, the ETF will then be listed on the exchange. So just as you have listing of shares, you will also have listing of the ETF, and then you can buy or sell more as you wish. So, but one big difference between an NFO and share IPOs that many times IPOs are oversubscribed. So, sometimes getting allotment is difficult or almost impossible. But in NFOs, there are no such oversubscriptions. Here, whatever amount investors put, all that amount is collected and then is deployed. After the NFO is over. So if you want to invest, let's say 10,000 rupees, if you put an application for 10,000 rupees, you will get allotted units for approximately that amount. Just a small amount may be refunded to you because only whole units can be used. But that's the basic concept. Whatever you apply with, all those units are sort of the closest number of units are allotted to you. There's no concept of oversubscription or not getting allotted, so on and so forth. If there's nothing wrong with your application, then you apply for 10,000 and you will get units also very very close to 10,000. So that's what NFO means in this context. You make an application, pay the money, units are allotted, and then the ETF will be listed on the exchange in early Feb. And sorry, I think the client had also asked how is it different from derivatives. So this is extremely different from derivatives. Here, the ETF is only investing in stocks, so there's no leverage involved. And therefore, when you buy, let's say you want to buy again, when the ETFs are traded on the exchange, you buy 10,000. You want to invest 10,000, you have to buy units which are close to number of units which will be close to 10,000, but there's no leverage in this. So that's a big difference between ETF and derivatives. That in a derivatives you have to post margin. With ETFs you have to just buy with the cash amount on day one itself. So there's no question of leverage with this ETF.
I think Shikhar, you can now conclude this webinar because there are no more questions. So if any more questions are there, dear customer, you can ask the chat box. If you have any question, you can ask there. But if you don't, we can just conclude. Okay, Shikhar.
Okay, so I'll just once again summarize that through the presentation we've talked about how these banks have made several sustainable improvements to their fundamentals. They've increased capital, they have cleaned up the balance sheet, they're changing lending patterns, becoming more digitally savvy. A lot of things have been done. Valuations are still close to the long-term average, so it's possible they are not fully reflecting all the improvement in the fundamentals so far. That's where the opportunity could lie today for investors to sort of gain from this disconnect. And just the NFO is open from 12th to 23rd, after which the ETF, all the applications will be processed, and then the ETF will be available to trade sometime in early Feb. At that point, you can invest more, you can sell if you need to, and you can also set up your ongoing SIPs as required. So that's it from my side. I think, Omkar, you can conclude if there are no other questions. Omkar, any more questions or you can conclude otherwise?
There is one more question from Mr. Saurabh. So
Yes.
he is asking, will get to know about the NAV while subscribing the NFO, or we will get to know once it is listed in the market?
So there will be, so the day the allotment is done, right? So allotment means that your that's the day that the fund manager will actually deploy the money. You will get units allotted at that NAV. So when you give the money, right, you at that day, basically the allotment happens a few days after the NFO closes. So you will not know the exact NAV that you will be getting. You will be getting the NAV as on the allotment day, which is, like I said, a few days after. So I think that was maybe that was your question. That do you know the NAV when you are investing? That will not be the case. You will, because when you invest is about even if you invest on the last day, the allotment is sometimes 2, sometimes 4 days afterwards, somewhere between 1 to 5. So whenever that's done, that is the NAV you get, and you cannot know it with certainty in advance. However, once the ETF is listed, then there's a INAV, for example, which is on our website, which is on the exchanges. Then you can see what the NAV is when you invest. But at the time of NFO, there is no NAV to track because the fund has not been invested as yet. Does that answer your question? Omkar, any more questions or any follow-ups? I can still take, no problem.
No more question, Shikhar, so we can just end up this webinar. So thank you everyone for joining this webinar. Thank you, Shikhar, for addressing us about this new NFO.
Yes, yes. Thank you. Thank you everyone for listening, and thank you, Omkar, for hosting. Thank you. Bye.